Today, we're going to do something a bit different. We're going to host a masterclass. We're going to talk about markets, cycles, capital intensity, and the question sitting underneath everything right now. Is AI a revolution, a bubble, or both? I recently hosted an episode with Zach Dykewald about China, and we explored how large systems evolve. They move slowly until suddenly they don't. AI feels like one of those inflection points. Capital spending is exploding. Semiconductor companies are now among the most valuable businesses in the world. Governments are treating chips like strategic weapons. And investors are trying to answer a deceptively simple question. Are we early or are we euphoric? History tells us something uncomfortable. Revolutions are real, bubbles are real, and sometimes they happen at the same time. So today we sit down with two Morgan Stanley market veterans, Mark Edelstone, Managing Director, and Colin Stewart, Managing Director and Vice Chairman. They'll help us understand this moment, how to think about it, where we are in the cycle, and what it means for markets and the world order. All right, Colin and Mark, thanks for being here. I really appreciate it. I'm looking forward to it and appreciate it being on a bit personal.
Very excited.
Thanks for having us.
This dialogue is going to be a little bit different than our other episodes. This is going to be more like a masterclass on the markets, okay? Because I've had the opportunity to have on a bit personal people like Jensen Huang and Lisa Su, Matt Murphy. And, after you listen to these guys talk about AI, you get very excited about where we are. And you realize, okay, this is something enormous. But you guys have been through enormous before, right? So you've been through telecom, you've been through .com, you've been through many, many semiconductor market cycles. And so what I would love is for you guys to kind of help us put into perspective the moment that we're in today. And, are we at the beginning of something extraordinary? Are we in the middle of something overheated? And maybe before you answer that question, maybe start by giving us a little bit of background on some of the cycles you've been through, the patterns that you've been through that have helped shape your perspective on this particular moment. And maybe start with you, Mark.
Sounds good. Well, first off, your podcasts so far have been fantastic.
Thank you.
So hearing Jensen, Lisa, Matt, and others has been really inspirational.
Thank you.
So in terms of my background seeing cycles, I've been doing this now since 1989. That's when I started covering the semiconductor industry. And the first 18 years of that was as a research analyst. It's really where I began to understand the details of the industry and really begin to build perspective. And the last 19 years has been as an investment banker. So I've seen an awful lot. I've lived through all these cycles, and it's been tremendous change that we've seen. I love the place we're in today at this point, because if you go back in time, the industry was growing very, very fast historically, like typically 5 times faster than GDP. When I started the industry, it was only $50 billion in size.
Amazing.
Next year, we're going to be, or actually this year, we'll be at $1 trillion this year. So run rate off of the first half of this year will be at $1 trillion. So that's just unbelievable growth to see in an industry in one's career. And, lots of cycles. In the past, they were really driven by mistakes that people made, put in too much capacity relative to demand, too many companies doing the same thing. So all the R&D dollars going after the same sockets. And so that led to price compression and just unabsorbed overhead in capacity and so on. And that created a lot of the cycles. As we moved out over time and the complexion of the industry changed, we started to see things transform a little bit. The industry used to be very vertical. Everybody had manufacturing, they did their own tools, they designed their own chips. Then, of course, we went to a fabless model, which you were a big part of. With the FSA and then moving to the GSA. And so that helped a little bit with just overall capital intensity for the industry. But it still is an industry that's very much tied to the economy. And as we get bigger and bigger today, we're just slightly smaller than 1% of global GDP.
Okay.
I think it should be worth a lot more than that. So it will be over time, but we're still fairly cyclical off of what happens in the economy because a lot of the industry is consumed by consumer, automotive, PCs, handsets, and so on. This cycle is a little bit different. This cycle is being driven by massive spending for AI, and we're early on And the rate of change of everything is just so massive, which I'm sure we'll talk about as we go through here. But it's just incredible what's happened, and it's increased the value and the type of drivers that we're getting out of the semiconductor companies today. It's already pretty pervasive in terms of the usage of semiconductors, but this unbelievable growth engine right now for AI, which is helping companies like NVIDIA and Micron and SanDisk and Marvell and many others, it's truly tremendous. And so it is different today.
Okay.
I think it's very sustainable. Like, we're early on in all the drivers need to happen to support AI. That's just in the data center. So we've trained up all these large language models. We're now taking advantage of the inference side of it. But then there's a whole nother big driver that's going to happen with physical AI.
Okay.
And that's still in the future, and there's still a lot more around it. So things have changed, but I think we're in a really, really good spot for this industry.
Yeah, I think that the first time that we heard that the industry was going to $1 trillion by 2030, I mean, people were like, "Yeah, right." I mean, it was a big forecast.
Yeah.
And I think the first time I heard it was maybe 3 years ago.
Exactly. And I would have said the exact same thing, and yet it's going to happen in 2026, which is pretty amazing.
It really is.
And so it's still cyclical. Of course, we lived through COVID, very cyclical. So if people let supply chains get, out of whack, get inflated, build inventories, that's a problem. That can always happen. COVID was our last real cycle, and it took a while to sort of work its way through. That's now behind us. And we'll see where this cycle goes, but I think we're going to find it's going to probably last longer than what people are currently, concerned about.
Okay, Colin, how do you feel about everything right now?
So just quickly, so like Mark, I've been doing this a long time. This is my 38th year at Morgan Stanley. And while Mark has been more focused on semiconductors, I've been focused more broadly on either emerging markets or technology. So I've seen a lot of cycles in those 38 years. So I've seen everything from, crises caused by geopolitics, whether it's the first Iraq War, the second Iraq War. I've seen Asian financial crisis in the late 90s, and then sat through the internet bubble, sat through the global financial crisis, maybe minor SaaS crashes along the way, but now to AI. So I've seen these paradigm shifts happen, and I have sort of a rubric that I use, which is every time you get these paradigm shifts, there's a 10x increase in the capital investment for these cycles. And so if you go back and you look at the move from whether it's mainframe to PC to internet to mobile to cloud to AI, there's always been this large step up in investment cycle. And if you take the cloud in total, it's probably about $1 trillion of Capex. So that means one order of magnitude more is AI. That's a $10 trillion Capex bill.
Amazing.
If you take the ChatGPT moment from that point to end of 2027, it's around $2.5 trillion of Capex at the big hyperscalers and some of the other players in the market. So that would tell you we're kind of in the very early innings of that move. And so, like Mark, I believe that there's a big wave that's coming, and it's going to have its own cycles for sure. But this wave is a little bit different than prior waves, in particular, or prior bubbles. To have a bubble, I think you need to have a bunch of conditions precedent. One, you have to have an amazing narrative, right? AI is going to change the way we work and the way we live. That's clearly a great narrative for the makings of a bubble. But the second piece is easy liquidity. You need a lot of capital, low interest rates, or just money that's sloshing around. Kind of go back to 2021 and look what happened to software and the tech market at the time. When you had $0 because of ZIRP, or zero cost of dollars because of ZIRP, valuations exploded. You also need high valuations. I mean, NVIDIA is probably one of the cheapest growth companies you can buy in the world. It trades at 20-ish times, a little over 20 times earnings, GAAP earnings, growing, you pick your number, anywhere between 40 to 70% in the next couple of years. So you really don't have valuations that seem stretched. You don't have easy money. You also don't have as much leverage in the system as we've had before. And so, there are a lot of things that say this still could run. But I think that the thing that's probably the most defining thing that we'll be trying to figure out over the next year or two is all this money has gone into infrastructure, gone into capital expenditures to drive AI. The return is the big focus. Where do you start to see the return for that investment? Is it manifested itself in either better revenue growth, better margins, increased productivity? Are you seeing more wide-scale adoption across the enterprise? That's still kind of on the come, or it's
Right.
evidence is starting to show, but that's the big question. The market grapples with that on a daily basis.
So in 1999, when we had sort of the internet, the markets were funded by equity. Okay, in 2008, maybe credit.
Yep.
So how are they being funded today? I mean, and I ask this because everybody will say, well, the amazing thing is that it's free cash flow.
Yeah.
But there was, I guess, a report last week with how Meta defined free cash flow was maybe different than others. So do you worry about that, of how this is being funded?
I think it's look, I think free cash flow is a large portion of it. And I'm sure that everyone has their own various definitions of free cash flow. But look at the balance sheet and the GAAP numbers for free cash flow. Companies like Microsoft, Amazon, Meta, Alphabet, these companies, their free cash flow, historically has been somewhere between 60 to 80, $90 billion a year. I mean, NVIDIA's free cash flow is over $100 billion a year. So there's a lot of capital there. They've also historically not been big users of the debt markets. So when you think about the percent of the equity market cap that these companies represent, and then you look at the percent of the credit markets, the debt markets that they represent, it's like polar opposites. These 4 or 5, these Mag 7, Mag 8, Mag 10, 45% of the equity markets, but they're probably still single-digit percent of the credit market. So they have an ability to retain investment-grade credit, to find that credit. They're also starting to do more creative things, right? They're looking at ways that they can provide a guarantee to these facilities. So Google, Meta, are using now kind of a look through to their credit quality to help finance some of the data centers by guaranteeing taking some of the offtake, or using the compute, or helping kind of figure out the funding for the equity piece of these data centers. So I think it's definitely a question, because when you look at that number I mentioned, that $2.5 trillion or $2.7 trillion, free cash flow only gets you a portion. It gets you a large portion of it, but then there's debt. There's going to be sort of structured debt, and then there's also just equity too, which is coming from sovereigns, coming from large players in the kind of institutional market. So it's not anywhere close to the things we've seen from a crisis. Like when you talk about bubbles where there's been a credit-driven or leverage-driven crisis. Again, these are the most high-quality, all high investment-grade companies that are leveraging their incredibly strong businesses to invest in a once-in-a-lifetime opportunity. It doesn't feel like they're doing things today that are risky. 25
years, I've heard CEOs wringing their hands about no one values us correctly. And it started changing, I guess, really about 6 years ago.
Yeah.
And it's great.
But, to the point that Colin just made about, say, NVIDIA as an example, Jensen and NVIDIA has changed the world more than anything else. It's why they're the most valuable company in the world today. But they trade at basically a market multiple, despite growing dramatically faster. In fact, if you took the 10 most valuable technology companies in the S&P 500, so that's obviously the hyperscalers plus NVIDIA, plus Broadcom, plus Micron. So 3 of those 10 are semiconductor companies. And all but one of the other 9 are doing semiconductors internally. Those companies collectively represent about 37% of the S&P 500. They're only 16% of revenues of the S&P 500, but 32% of profits. So they are growing fast, they're very profitable, and they deserve the valuations. But if you aggregated them, they only trade a slight premium to the market today, which is amazing.
Most of them trade at or slightly below or slightly above the market multiple.
Okay. So why is that? Just because NVIDIA is sort of the poster child for things gone crazy, or the bubble that everybody fears?
I think it's funny, the last earnings that they put out were phenomenal. And yet the stock kind of went down on the back of it. So I think a lot of people were scratching their head, like, how can a business grow that fast, be that profitable, be that dominant from a share perspective, and yet not be rewarded? I think a lot of people point to it's a big company, right? It's the largest market cap company in the world, and it takes a lot to move that. Some people say, well, maybe all the good news is in the price, right? Like that will be the line of logic, which is, we've just seen every hyperscaler increase their capital expenditure budget for this year. Like, is it really going to get better? And they're obviously among the biggest customers of it. So again, all those are kind of, maybe very short term or very sort of like kind of things that the market loves to focus on. But I think the long term, I think we think it's still undervalued and will grow fast. And there's no reason to think that the market, the multiple it gets to capitalize its business, shouldn't expand just because of the quality of what they do.
Right.
Yeah, I think the big thing that investors are struggling with, and NVIDIA is a good case in point, but it's true across everything, I think, in tech and in semiconductors in particular, is we see this unbelievable growth. How sustainable is it? And so is that demand real? So if you've got this incredible driver that has gotten companies like NVIDIA or Micron or others to the level they're at today, the question is, how sustainable is it? So I think Colin said earlier, if you take this view that says we'll take what was the cloud era and we'll increase that by an order of magnitude in terms of everything that comes from it, all the demand drivers, all the supply you need to basically go make it happen. So we're still early on in that. That's going to be the debate that takes place here. I think investors will figure it out. And if we come to a conclusion that just simply says that this is going to last for a while, then maybe you don't see a lot of multiple expansion, but obviously you'll get paid for that tremendous growth that's happening. Those 10 companies I mentioned, the 10 most valuable in the S&P, they're expected to grow 33% this year. That's way faster than the economy, way faster than the other 490 companies in the S&P. And so the faster you grow, the more valuable you should be. And so I think that's how it will ultimately play out. But people are just worried about the cyclicality, and is there this whole concern about the bubble. I think AI, to me, it's extraordinary. I think it will last for quite some time. And the debate is there's massive opportunities for companies, but there's also going to be a lot of disruption.
Right.
And so that's a big debate that's being waged now about software, how that just completely changes the way software companies maybe get built and run in the future.
Well, it seems that, so let's talk a little bit about the market's interpretation rather than just the companies. So it seems that the market is very emotional. I mean, so I guess it was last week, maybe the week before, that there was this scenario analysis that went viral about, that AI is going to wipe out white-collar jobs, and therefore that's going to impact the economy, and put together this whole kind of fictionalized account of what will happen. These headlines that people almost are just waiting for, right? So one is, why is the market so emotional about this? And at the end of the day, what you guys always say is the market's always right. Is it always right?
Well, so my foundational belief around markets is that the markets generally are very poor at predicting the future. I mean, I think if you can go back and look over time, like what everyone says that they have a view, they have a view, could be optimistic, could be pessimistic, but generally speaking, their ability to predict, whether it's an economist, whether it's a strategist, whether it's an investor or portfolio manager, it's really hard to predict the future. And I think in particular, what's really hard to predict are the surprises to the upside, the surprises to the downside. And so I think, but that's what people focus on when these reports come out. So I kind of joke with my team, like people are investing by Substack articles today. People who are deep in it are educated, but there's not data yet that says that's going to be the outcome. And I think because these paradigm shifts are there's such a tectonic event in the industry that people are kind of grasp at these outcomes because they sort of start to look at their portfolio and they worry about whether it's a black swan or sort of this long tail outcome that could be very, very disruptive. But again, the data is not there to support it. And again, we'll only know in hindsight who was correct. The reality is there's only usually one, Nassim Taleb, or there's only one Michael Burry who predicted the credit crisis. Everybody else got it wrong. And so the vast majority of these things, I think people are a little frustrated. I'm frustrated because as you look at what these reports, what they say, what they contextualize, it could be a scenario, but there's no probability that's being assigned to it. Yet it kind of flows through the market as if it's kind of gospel. So the report was, not only was it bad for software that day, but it was bad for financial services and payment companies like Visa. Right. It was bad for insurance stocks. And again, like you just start extrapolating, and it feels more like these reports are sort of catalyzing people who have relatively short-term trading views in mind and are taking advantage of kind of just the disruption, which is it's a difficult thing to see through, right? Sort of like the analogy we made, the fog of war. Like you don't know if you're a portfolio manager how it's going to play out, and so your defense is, well, I'm just going to be either less invested or less exposed is the only way I can control my outcome until things begin to come a little bit clearer. So again, take enterprise software as like the case in point. Like that marketplace has been, kind of eviscerated over the last, kind of 6 months or so, and particularly the last couple of months where whether it's Claude Code or Citrini or others, and people are just wondering what's the end state for this businesses. I would say the end state is clearly is going to be less companies, but there are going to be some amazing winners in it. But the market's not willing yet to sort of underwrite the winners yet, or that thesis, because it's too hard to tell who's going to make it out until you see more data. And the data would be, are these companies putting intelligence into their product? Is that intelligence actually, providing real value to their customers? Mm-hmm. Are you seeing that value then being manifested in better revenue opportunities and revenue growth of these businesses? You haven't seen that yet. And so until you start to see that, then I think you can answer some of those questions. But in this environment we're living in, it's hard to get people to sort of make a stand or put their foot down. So this is value, this is interesting, this is cheap.
It's easy to sensationalize, I think. Yeah. And so if you're a pundit or you're doing research and you want to come out with a bold prediction, no one's going to know if you're wrong or right for a little while. Right. I mean, you think about where we are.
Yeah, you get the headline.
You think about where we are today. ChatGPT was launched on November 30th of 2022. It's not that long ago. And think about what's happened since that. It's pretty amazing. Mm-hmm. And so you now have a market that's trading at like 21, 22 times earnings. That historically is not particularly low. And so when you've got that and you got everybody who is trying to figure out what the future looks like, it's very easy to come out and have some negative commentary that causes people to flinch. Mm-hmm. And that's driving volatility here at the moment. And again, some just amazing stats. So if you go back to 2020, go back to the cloud comments that Colin talked about, total capital spending for the cloud Capex was like $120 billion a year in 2020. This year's going to be $800 billion. It's going to be over $1 billion or over $1 trillion, I think, in 2027. That's just massive. And so when it relates to, and that's obviously all AI driven or broadly AI driven, and yet we don't know what we're going to use AI for sure when we look out in the future, because the rate of change here in terms of what's been happening is just extraordinary. As we've gone from generative to reasoning to agentic, it's just so fast. We've never seen anything quite like it in the world.
They'd liken like the ability for AI to code, right? Maybe it was 12, 18 months ago was coding like a sixth grader, right? And then like this, now it's coding like a PhD student, right? Mm-hmm. Like it's happened so fast. Right. Like the improvements in these models have gotten so good and it's so fast and so quickly that now people are extrapolating that to other segments, in mm-hmm. whether it's your infrastructure, whether it's in your, workflows. Like you can now start to extrapolate, well, if it's doing that well on this, certainly it can do better across these. And so you can see how disruptive it can be.
So some legitimacy to every headline, right? I mean, but yeah. Until you dig deeper.
Yeah, but what's kind of amazing, if you looked at the broad market, it's been just kind of going sideways.
Yes.
So, because we've seen a lot of rotation happening within the market. And I think that's probably pretty reasonable to think.
Right.
If you go back to where Liberation Day was, where the market came under pretty significant pressure, our view at Morgan Stanley is that was probably the start of a new bull market. And bull markets don't just last for 9 or 12 months. So you're going to get some volatility, you're going to get some churn that happens, but the economic environment is just sort of okay. And so as long as that holds together, you're going to see broadening out into things beyond just this whole AI trade that'll be quite helpful to the broad market.
This episode is brought to you by Morgan Stanley. Morgan Stanley celebrated its 90th anniversary last year, and its tech investment banking team has prided itself in working with the most innovative entrepreneurs and leadership companies for decades. During that time, they've led IPOs for hundreds of tech companies, including Apple, ARM, Astera Labs, Broadcom, Cisco, Facebook, Google, NVIDIA, Salesforce, and Uber. In addition, they worked as a trusted advisor and executed thousands of M&A transactions for some of the most industry-defining deals in technology. Throughout the years, Morgan Stanley's tech investment banking team's success has been achieved by dedication, consistency, and a North Star purpose of helping its clients to maximize their opportunities and overcome their challenges. Now, let's get back to the episode. When we look back 1 year, what headline do you think is going to be the most significant? Like the DeepSeek headline was in January last year. So when we look back a year from now, what headline do you think that's come out in the last maybe 6 months or a year will still be having an impact?
Well,
will it be this Claude moment?
I think it's this code generation is just very different. And the question is, how do we leverage that? It's hard for me to believe, for example, it's not my expertise. I specialize in semiconductors, but it's hard for me to believe that every software company is going to not have a business in the future.
Right.
So I think they'll be able to leverage AI tools and capabilities to make their businesses that much stronger. But we will see. Like here's one of my favorite things that I learned in the last 37 years of covering this was from Andy Grove. You talked about paradigm shifts. He talked about, this is basically in the early 1990s, about how paradigm shifts can basically transform companies or sectors at a strategic inflection point. And that's where you have kind of legacy suppliers that don't kind of get the transition at that strategic inflection point, at that paradigm shift, and their businesses head south. And then other companies have a much brighter future. And so this is like examples of going from CPUs to GPUs as an example, or from cell phones to smartphones. There's been many examples of this, and who knows if the Claude moment is going to be part of that for software. It's hard to know, but really important to watch. So that's the lens I use when I try to figure out who are the winners, and it's hard, as you know, in semiconductors to figure out who's going to be a really successful company. Who's going to be the next Astera Labs? Who's going to be the next, Marvell, Broadcom, whatever? And I do it through that lens of who has, innovation, durable businesses that are going to be able to take advantage of these paradigm shifts and strategic inflection points.
So when you are advising or talking to boards or CEOs, how are they looking at AI? Are they looking at it as a productivity tool? Are they looking at it maybe to transform actual headcount or margin expansion? Or are they just trying to do whatever they can because they need to compete? I mean, how are they viewing AI within their own company?
Well, I think within semiconductors, it's pretty clear that they're going to drive it. So it's the foundation. It's a lot of the technology behind how you're going to basically support the compute need and feed it with memory. And there's obviously, companies doing things where you put, compute in memory or very close to memory. So it's really important for those companies. For the broader world, I think it's a little bit different.
But what about how they're utilizing it? How are whether it's a chip company or others actually within, whether it's for the chip design or the workflow?
So Datadog's a company that we spent a lot of time with. Datadog talks about it in their earnings transcript. They talk about AI in two ways. They have Datadog for AI, which is what Datadog is doing by putting intelligence into the products that they sell to their enterprises and their customers. And then they have AI for Datadog, which is how is Datadog actually consuming AI, both from improving workflows, improving productivity, enabling them to do more. And so it's a combination of those two. Most companies, and Datadog's a software business in the data infrastructure side, and they're looking at I want to be able to serve my companies with the best AI tools. And so then I also want to be able to make sure that I'm leveraging those tools to make my business more important. The question around like headcount is a really, tough one. It's an interesting discussion, right? On one hand, you have Jack Dorsey, who just decided to let go about 40+% of his workforce. And a lot of it saying we can do basically same with less effectively, or maybe a little bit more with less. But I think a lot of people are thinking about it as kind of in that, like I kind of simplified to, I can do the same with less because AI makes me much more productive. I can do more with a little bit less, or a little bit more with a little bit less, or I can do more with same, or even more with a little bit more. And like I think those are the four different outcomes that companies are thinking about. And I think many companies are not as dramatic as Jack Dorsey. He's in kind of the same with less. And then on the other ends of the spectrum, if you just look at like the recs for hiring across the software industry or across even the AI companies, the large language models, they're all still hiring very aggressively. So, or they're looking for talent. Even in Amazon, which goes through regular layoffs, still has tons of e-recs out for new people. Right. And I think they even said in one of their reductions in force that we expect many of the people who are leaving these jobs to be hired in a different job within Amazon. And so I think that's kind of the question they're trying to answer is like, because I think most companies, if you're built for profit, you'd rather there's a one-time change, which if you do same with less, which is I can be a lot more profitable. Once that's done, like again, what drives business ultimately, right, is growth and free cash flow or growth and profitability. That only affects one of those axes, which is profitability. If you can do more revenue with better profits, that's ultimately the ideal. I don't know if they've titrated yet the right formula of what level of headcount, what investments in headcount do I make, what investments in AI to make. But I think for most people, it's going to be more that way, which is, can I grow my business better with AI? Can I be more productive? Can I be more efficient? As opposed to just wholesale, like I'm taking heads out.
Because I heard it from an investment banking firm that said this will be as large as we ever are.
Yeah, it's quite possible. I mean, but it may be within that population, it may shift around.
Okay.
And some investment banks are built in with the biggest banks in the world, are probably some of the largest law firms in the world, right? If you imagine the number of lawyers that sit inside of JP Morgan, it probably rivals a top Wall Street law firm.
Okay.
Like the question they would be asking themselves is, do you actually need that number of people now with AI? Can I get more of that analysis done? Because AI is there's most of law is now sort of digitized and sort of analyzable and run through models. It's text based. I can get all the data I need. Do I need as many people doing that? That's a good question to ask. Okay. But do they take that and shrink the headcount, or do they redeploy that into what they can grow? And so I still think you're going to have net growth for some of these companies for a while, but it's going to be smaller at the margin than you would have originally planned.
So if you did have a slowdown on the enterprise adoption of AI because maybe someone isn't seeing that return on investment, that could be very disruptive. I mean, are you worried about that? How quickly do people have to see that ROI in order for that not to be an impact?
Yeah, I mean, that's definitely, look, again, when we started, I think in my opening comment, I said the big question is on the return, right, for the spend that you're doing. It kind of, to the enterprise, it's the same thing. If you're taking part of your budget, that may have gone somewhere else, and now you're putting it into AI infrastructure and AI tools, and you're not getting the benefit, then I think for sure that's a question mark. You'll slow it down. I think it's less about us getting a return. If I think about us as a customer, Morgan Stanley, it's more about, can we get the tools that actually work within our regulatory, our compliance, and our security architecture that we need, as opposed to getting returns. I think the returns within our organization, you can just think of so many ways to find the returns. One simple one would be expense management. How many expenses are reviewed across a bank like Morgan Stanley or across other enterprises are actually reviewed today by a human? Probably more than, I would say the answer is I don't know the number, but it's probably more than it needs to be. Okay. That's a pretty easy thing to kind of figure out how to kind of put rules in place that can solve a lot of the basic questions when you're doing those reports and figuring out expenses. So I think there's going to be ways to find it. I think the bigger challenge is making sure it fits within the overall architecture. As a regulated entity, think about healthcare the same or others. Like you can't just put something in the wild and let it go. You actually has to be sort of set up and managed in a way that actually is compliant, and that takes some time. So I think I'm less worried about the returns in the immediate near term, but just worried about the obstacles of making sure that what we put into the plant is actually the right sort of software tools that based on sort of what our needs and sort of wants are.
Is there some point that is the most fragile in AI that could cause a big disruption? Again, I asked about enterprise adoption. If that slowed down, that would certainly be a disruption. What else do you worry about that could disrupt this?
I mean, I think that's probably the big thing is, are people getting the returns that they expect? And I think we're still early on in this to be able to determine where that's going to be. For companies that don't make the investments, they're probably going to get left behind. So they do need to make, some, got to be some leap of faith, if you will, that there's going to be productivity that happens. And like that's the data that we're seeing today. I mean, we see it for sure inside what we do. We're way more productive with AI tools than without them. And so I think that's where things will basically head. I think it'll be a continuum of, some companies that just will take the approach that just says, I'm going to do, the same with a lot less people, but there's going to be others that'll basically plow it in and find ways to get, more things that they'll basically build and deliver over time.
Because I think that productivity argument that, for example, we can get rid of, 200 people that typically answer a hotline for customer service that you turn over to AI. Okay, if you got rid of those people, yes, that's a savings. But a lot of these productivity gains are just maybe making customer service better, but they're not really. I mean, you don't really see it at the bottom line. I mean, there isn't that return yet. So I think that people, certainly
it's definitely on their minds. I mean, I think the things that give me a little bit more confidence, if you look in like businesses like Meta and Alphabet, I think are good examples of businesses where maybe it's hard to disaggregate, but if you look at their business from a growth perspective and kind of profitability perspective over the last couple of years, as they've in a way been using AI, into their core businesses, whether it's the algorithms that serve ads and other things like that, the businesses have actually, I mean, if you look at their businesses, it's accelerated. And so now again, you can't there's no line item that says, this is the challenge, right? There's no line item that says AI revenue, to show that. But if you just look at how fast and how dynamic those businesses have been over the last couple of years at this scale, to be accelerating at scale is really impressive. And so that's at least one area. So it's helped their business for sure. Is it driving more margin? Yes, it is. Are they spending more because of it? Absolutely. And so I think as you get more examples like that, and then maybe that's not as clear cut as, a simple sort of line item that someone may have, like if you're a Salesforce or you're a ServiceNow, here's my AI revenue skew and what it's growing. But I think it's very powerful and certainly been a driver to their stock price performance. And so if more of that starts to manifest itself, I think you start to answer that question. But it could be, it could take another 12 to 18 months to show that.
But those are good. Those are great examples of companies that I think most people acknowledge that AI has really helped their business.
Right, but that's all happening at a time when global GDP is below trend line. So we've got a $120 trillion global economy, expectations like low 3% type of growth here. That's below historical trends. So you can imagine if we get to a point where we're growing at trend line or better, what does that sort of mean for all the, the growth that will happen for these companies by themselves?
Okay, so a lot of times when people talk about AI, it's one thing, right? And it's one company that people have in their mind that whether it's OpenAI or whomever, but of course AI is an entire ecosystem, right? So help the listeners to understand sort of every layer in the stack, like who plays in the top layer, who plays in between, all the way down to applications. And so kind of help us draw that mentally, and then maybe where the value is being accrued today.
Well,
I can start with the foundation,
yes,
which is obviously going to come from semiconductors and platforms that people build around those. So you ultimately have to do compute. You got to have memory because you need to basically be able to feed. You need to have data that's going to go feed and get processed. You need to be able to have interconnections and connectivity within that, and that's for data centers are going to be driving what's called scale out technologies, which today is all largely copper-based, some optical. In the future, we'll see more scale up. So you'll see more of a transition to optical as a result of that, just because we'll run out of the physical limits, basically, of what you can do with copper, wiring. So there's a lot that happens.
So you don't have to just be in the data center in order to benefit from AI for a chip company.
Oh yeah, exactly. Yeah, for sure. And AI is going to, we see what's happens with Waymo as an example, or we're just very early days in robotics, like super, super early. And that's going to have, all kinds of semiconductors that go into that, right? Sensors, motors, all those kinds of things. It'll be pretty significant. I suspect bigger than the automotive industry as an example. It'll take time to get there, but that's a whole nother trend that's going to happen as well. So you've got semiconductors, I think, will be the bedrock foundation for a lot of stuff that happens. And then from there, we'll move up the layers, up the stack, if you will, into software and applications and things like that. That'll basically, have all the value
And
drivers.
where are the hyperscalers there in that chart?
Well, they're providing all the services
Okay.
behind it, and they're also, I think, trying to capture some of the foundational technologies, which is why they're all effectively trying to do their own semiconductor development, but it's hard. So to me, if you can design semiconductors and you can use that across lots of companies, like what a Broadcom does, I think you just have a better ability to basically leverage your R&D, your capabilities. Being vertical can be very good. You know what the workloads are, but it is a bit harder.
Right.
But they're providing services and the platforms, if you will, to then enable the rest of what's happening in the other layers.
Yeah, the way sort of I sometimes joke about it is it's called follow the gross margin.
Okay.
In the old day, in the cloud world, the gross margins, the best gross margins were actually in the application layer. Right, so the biggest software companies were earning 85% gross margins in that business, and as you move to AI, actually some of the best gross margins are actually at the chip provider level of that technology. It's the NVIDIAs, it's the AMDs of the world, et cetera, that have some of the best margins, and then it kind of goes down from there. And so you've got, if you think about it, you've got the software application that's coding on top of one of the big LLMs. They're actually running their compute on a hyperscaler or a data center and then that is buying chips and infrastructure and gear from that whole layer of what Mark has covered for the last 39 years. That's where a lot of the value is accrued today. You're starting to see it change. It'll change a little bit for sure, because as you get to scale, the layer in the middle, the LLM layer and the application layer, will start to sort of see improvements in the gross margin. But it's been a tough business for them because they've had to pay out so much along the way. But I think it's starting to change, because you're now seeing, coding as an example, right? Coding, that business went from probably de minimis revenue 2.5 years ago to now multi-billion-dollar sort of ARR business. So it's gone from essentially zero to a very large number. As you get to those large numbers, that starts to become very profitable with very good gross margins on top of it. You've gotten to scale with it. And so that'll start to happen. It will roll through all the sort of LLM and the applications that are written on top of it as well. And so, again, what you're seeing already, I think, in the VC community, in the early stage startup community, like the amount of dollars it takes, the amount of people it takes to bring a product to scale, vastly different than it was 10 years ago, 15, 20 years ago in the cloud environment. You can do it with probably 25% of the people and probably a lot less with a little bit less capital. So and these businesses can scale. Right, and then the capital is going to compute, it's going to to consumption, and you're seeing these businesses again, like the number of new company creations and the number of new apps that are being put into the App Store. I'm probably not all-time highs, but they're at near highs, like after a big lows. And so you're starting to see this already, this environment start to be created where there'll be a little bit more diversification of how the value and the gross margins get split up across the chain.
Okay. So, Mark, we were talking earlier about the cyclicality of the semiconductor industry, and when we did start GSA, one of the thoughts was that if you have a fabless foundry business model, the cycles are going to be tempered because you have fewer people making decisions. You said that earlier.
Yeah.
So, does that really mean, though, that now the semiconductor industry won't be cyclical? You look at memory as an example, and it's the most cyclical part of the industry. But, right now memory is, the demand is huge and the capacity is small. So is that just an issue of, well, as soon as capacity ramps up, it'll change once again, or people will overbuild on the memory side?
Yeah, unfortunately, I don't think we can ever eliminate cyclicality in this industry. It's just not possible. But we can make it better. And I think we can change the amplitude of some of it over time. Memory is particularly difficult because you've got 3 big players by and large in DRAM. You've got more in NAND, and so it is hard and it's difficult. You can't just bring on capacity in small increments.
Right.
It's pretty chunky. And typically, because it's just human nature, you're not going to build plants until you've got lots of demand. And ultimately, you're just going to probably get to a point where supply is going to overshoot the demand. And if that happens during an economic slowdown, it just amplifies the problem. So I think there'll be sectors that are always going to be quite cyclical. That's why, unfortunately, I look at Micron or SK Hynix or Samsung and what they do, and it's extraordinary. It's so hard what they do.
So hard.
And yet Micron trades at 10 times earnings. That is less than half of what the S&P 500 trades at. So it's crazy to me. I think ultimately that will change, I believe, because it will. It's just there's not going to be another DRAM company, I don't think, that can do what they do. So ultimately, I think they'll get more pricing power and it'll be less problematic. But it's always going to be somewhat cyclical because of the factor I gave you. Now, the rest of the industry, when you look at the fabless companies, I do think if they manage inventories well, and they've typically done a good job. COVID was just, I think, a very bad example because it was just such a massive hit to the supply chain. And everybody began to understand the importance of semiconductors when the golden screw wasn't available. So you couldn't buy that car, you couldn't get that washing machine. And so people just said, well, great, let me just get all I can. I'll basically over inventory. And we all know how that movie ends. I mean, we all have been doing this for a long time. We just know there's double, triple ordering. And then ultimately, when things slow down, you just cancel things. So I think that's an unusual time. I don't know that we'll see something like that in the future. So for the rest of the sector, I do think it will be less cyclical, but we won't ever eliminate the cyclicality entirely. The good news, though, is that for these fabless companies, they've got variable cost business models.
Right.
So you don't have all the under absorption that you do if you've got a manufacturing facility. So the NVIDIAs and Broadcoms and Marvells and MediaTeks of the world, it's going to be different for them when we get to the next ultimate downturn, because their gross margins will hold up. And the challenge is just how much does revenues fall relative to your OPEX that you need to basically try to cover. So some cyclicality, but not terrible. And I think largely it'll be kind of tied to the economic environment.
I mean, do you think that it's possible that a different model emerges from AI because the demand is going to be so huge? Can it really just be TSMC and a few others that are supplying this now $1 trillion industry? I mean, is that possible? Or you think that fabless companies will begin to make investments in capacity differently than they do today, which would affect the margins?
Well, TSMC is an amazing company. And quite frankly, I don't know that our industry would be where it is without TSMC. So they've been incredible. They can drive technology extraordinarily well. You hear all these companies talk about first time right silicon. I mean, so the whole industry is just so much better managed today, and TSMC has been a big part of it. But we do need, I think, to have broader manufacturing. I'd be very surprised, outside of maybe there'll be a couple of examples. I don't think that most semi companies that today are just design firms will go and basically build capacity themselves. But you've got Global Foundries, UMC, Intel. So you've got other centers of excellence that can basically build over time. And then there's other parts of the industry like, within analog, it's just a very different model for TI or analog devices and whatnot. Just the capital intensity is just very different. But for big digital, it's very hard. But I do think we'll have other people than just TSMC. We kind of have to.
Well, it's definitely when you talk about the kind of the supply demand. I mean, there are definitely real choke points in this AI story that make it a little bit different than other kind of bubbles or other things that you might think would be a bubble. TSMC is a choke point, right? That all the silicon has to go through TSMC mostly for what's being done at whether it's AMD or it's NVIDIA or others. And then you have memory as a choke point that may get solved. You have power. The availability of power in the U.S. is an issue. It's not easy to do it. It's not easy to bring online. There are real political and social costs of power. You have the lack of infrastructure from a workforce perspective to be able to put these together. Not easy to go find bunch of people to put these data centers together, right? You're seeing slowdowns in many of these companies in terms of their build. And so there's some of the governors which kind of mean that the compute the supply demand for compute will probably still stay kind of undersupplied and over demand for a while, because these choke points aren't easy choke points to solve. Like, it's not as if Hynix or Samsung or Micron can snap their finger and put a lot more capacity in. Same for the fab for TSMC. Same to find workers and train them up. Same to be able to get power through. So there are some natural things that kind of put some governors on the pace at which the supply-demand balance can shift dramatically. And I think that's one of the reasons you feel more optimistic about there not being, sharp, cycles or things. You're looking around the corner for something that could go wrong. It doesn't feel like those are going to be help. Those are going to govern like the pace of
because they're constraining.
They're constrained
the acceleration. Yes.
Yeah. I mean, every company we talk to, when you ask them about their demand for compute, would tell you they can't get enough of it. Right. I mean, you watch what's happened to tokens have gone kind of vertical, and you look at where they were 12 months ago, you look where they were 2 years ago. People just can't get enough of it, and so there's just not enough infrastructure to put into the ground fast enough to solve some of those issues in the next couple of years.
So one of the things that's different today than for sure 5 or 10 years ago is that the governments are very involved in semiconductors. Okay, and so there's semiconductors are now what everybody emphatically cares about, right? If you're a government, U.S. government specifically, and so it's changing. I think changing the entire industry. It's certainly changing the personality of the industry, and I think that there's a lot of risk to that, including that companies are going to be driven by something other than market forces and the decisions they make. So how much do you guys worry about that? What do you tell investors is that a downside, or is that good for the industry? Is it a good market driver because you know that semiconductors are important?
I think the focus, again, maybe on the U.S. itself. I think the focus on the U.S. is, again, they want to reshore critical manufacturing to the U.S., or at least a portion of that manufacturing to the U.S. I don't think it's, and that's going to be in areas like semiconductors. It's going to be in areas of AI. It's going to be in areas of, mission critical, whether it's rare earth minerals, whether it's parts and supply for, the defense infrastructure, et cetera. They all want that to be built here. I don't think that's a bad thing to reshore some of the critical parts of that manufacturing, the high value add manufacturing. I think it's actually very positive for the economy. I think it's actually, when you think about the job, what we just talked about from earlier about the job loss potential, there's actually a ton of jobs that will be created. Hopefully it's efficient. Hopefully the investments make sense from an economic perspective. Certainly this administration feels that there's a real desire to make sure that it gets done and gets done well with kind of buy-in from industry, and it gets done on economic terms. But it is a risk if it, I think it's a risk for us geopolitically if it doesn't actually happen. So I think it is an imperative, and I think there's a lot of momentum behind it. You see, whether it's, I think they all have different versions of it, American resilience, American dynamism. There's all this talk about that, and I think that's an important part of the next, decade for the U.S. as it builds back some of that critical infrastructure. And certainly AI and automation is a huge part of it.
Right. It just seems that one of the things that the semiconductor industry has been so successful is inefficiency. Okay. I mean, it's just, it has to be such an efficient industry. And so I just think that too many governments getting involved, everybody's going to want their own ecosystem. And it just, I think that there's a lot of risk there, but.
Yeah, you could have overbuild risk. It is very good, in my opinion, that we will reshore some of the stuff here in the U.S. so we can kind of control it. The good news is that this industry is still very much led by the innovations coming out of the U.S. companies, and so that's not always the case. There's really interesting data as well. If you look at this is just a broader sort of question around tech and what's driving innovation out there. If you took the 100 most valuable companies in the world, so the 100 global most valuable companies, 2/3 of those are here in the US, and they're 80% of the value.
Yeah, incredible.
Within technology, they're basically about kind of like the same percentage of, tech in the S&P. It's about 36% of the total. And so it's pretty amazing how that plays out here for our companies in the US. It's just, so 36% is basically of those, the 100 most valuable. And 80% of that number are US companies. And so that's very valuable. So I guess the risk is that you see other countries that look to do things, create some of these inefficiencies. I agree with you. When the world was flat and you could just have supply chains that just were logical to be in different parts to leverage the capabilities, that was a good thing. I think we'll just need to see incentives to make sure that happens, on our soil here, and just make sure that we've got the critical capabilities to make sure that we just continue to lead in whatever is next for technology and for the world.
So do you worry about the semiconductor companies in the U.S. being shut out of the China market and therefore just losing what is a huge market opportunity?
You look at the global economy. I said before, it's $120 trillion. We're about 22% of that, and China is like 17. So between the two of us, we're 40%. So it would be unfortunate if we can't have access to the China market. I tend to think, though, that we will. And so it may be portions that are excluded, but I think in general, we're going to probably find that there will still be an ability to basically go do business in other parts of the world. And we're kind of all dependent on one another. And at the end of the day, innovation and execution becomes mission critical for how our companies will continue to evolve. And will we still be the biggest economy in the world a decade, 2 decades, 50 years from now? I hope so. I'd like to believe we will, because we've got still incredibly bright, innovative, hardworking people that want to continue to change the world around us. But we've got it's a big world, and there's lots of competition out there. And planned economies have, in some sense, an advantage, but they also have a lot of challenges too.
Yeah, because this isn't a planned economy, right, in the U.S., and as you said, we own 80% of the value. So it's pretty incredible. We did that without any government involvement at all.
Right.
Very little.
Exactly.
Yeah.
And so
and the government involvement doesn't have to be just money, right? I think back, like, China was very deliberate about how it crappy, because it came out of totally, basically 100% of the GDP was owned by China. It was owned by the government at one point. And they were very deliberate, and I've watched them go through these different phases. They wanted to create big companies that could compete on a global scale, right? So they took critical industries, petrochemicals, oil and gas. They kind of took it down to 3 companies, right? They had an offshore oil company. They had 2 petrochemical companies. They did the same in telecom. They wanted to create kind of real winner that could compete with the petrochemicals, wanted to compete with Exxon and the Shells of the world and the BPs of the world. The telecoms had to compete with the AT&T, the Verizons, the Vodafones, the British Telecom, et cetera. They're trying to do the same in technology. And I think in the U.S., we've had because of the foundation of our business, our capitalism, and how we've built these big businesses, and they've kind of grown organically. But I do think that the government support doesn't have to just be money, but it has to be enabling them to be able to make investment decisions that actually make sense in this country, from whether it's a regulatory perspective, whether it's a fees and permitting perspective. There's all these things that can be helpful to these businesses to want to incent them to be able to put money and to put sort of steel in the ground, put boots on the ground to be able to build these industries. So I think I'm very optimistic about that piece of it.
Okay.
Because we've shown we can compete. These industries can compete. We're competing with someone who may have a lower cost.
Right.
But I think we can compete, and we can allow that to happen here, because we'll be probably we should be the best at automating. We should be the best at leveraging artificial intelligence and putting intelligence into our workflows and processes. That's going to enable us advantages. And I think as long as the government they don't have to necessarily seed it with capital, but they can seed it they can kind of create that sort of environment in a number of different ways that doesn't necessarily, I think, lead to inefficiencies in this way the businesses are run.
Yeah, one macro point there is that I think it's fundamentally hard for governments to pick winners. And so what you just described, and maybe that's the challenge, it's hard to pick a winner. You can maybe do it today, but things change pretty quickly. So you go back and look at what's made the United States so great and why we've got 80% of the value of those companies here, I think it's because you just got this innovation and because capitalism is kind of ruthless.
Right.
And so if you don't execute, if you don't continue to innovate, you get run over. And so look at, just take a look at how our industry has evolved with companies like Digital Equipment Corp, Compaq. Like there's reasons why those companies don't exist anymore, but they got replaced by other things.
Right.
So again, you take like that example I gave you of 2010 versus now within compute. HP was on that list in 2010. They're no longer. It's replaced by Dell. And within semiconductors, you would have had Intel, Qualcomm, and TI on that list in 2020 of the 5 most profitable companies in semiconductors. They're not in the list anymore today. And so are they great companies? Maybe, but things change. And so if you have a forcing function of like a government entity that's going to try to dictate who is going to succeed, what's the national champion, I don't know if that's great, especially in technology where the rate of change is so fast.
Yeah, I mean, you've seen it in China. You've seen, despite the fact that that they supported SMIC, for example, was the state champion, and never quite. I mean, now SMIC is doing fine, but the point is they're not going to compete. Yeah, exactly. Okay, so we'll end on a couple of questions. Sure. One is what can change in the next 6 to 9 months that would change your mind about AI and maybe how enthusiastic you are?
Well, I'll just say it's if we don't get the returns, if we can't get the things that are basically driving the investment, the usage model, that would obviously change my view. But I'd be very, very surprised because, again, I think we're very early on in terms of how that goes. I guess you could have intervention that says we're not going to allow you to do certain things with it. That could be an issue, in terms of how regulation goes on that. But otherwise, 6 to 9 months, I mean, we're going to see still a lot of change. But I think it's hard to unseat it in that period of time.
Yeah. I'm probably the question is more like, what's the risk? I think the upside would be the new models that are being trained on Blackwell will be coming out over the next 3 to 4, 5, 6 months.
Okay.
So I actually think you're going to see a lot more interesting things that are really supportive to the sort of curve that we're on, this curve of performance continue to stay. Okay. I think the models that are trained on Blackwell will be phenomenal, right? Like, because again, what you see each time there's been this, you trained on Hopper, then the TPUs, the TPU-8, and now it's going to be Blackwell, and the improvements that they continue to make, and the sort of efficacy and the performance and the throughput is going to be, I think, again, it's going to lead to, again, stair-step functions and the ability of these models to deliver value, whether it's on coding or whether it's on agentic commerce or e-commerce or other things like that. So I actually think when you start to see these results of these models start to flow through, probably like late second quarter, summertime into the fall, I think that's going to be actually another catalyst as opposed to something that's negative.
Yeah.
So do you worry about memory or energy slowing? Or capacity. Those were the 3 things that our CEOs put up flags about. I mean, those have to be solved, right?
They have to be solved. I mean, again, I think it's hard to solve. Those are not easy issues to solve, and so I think we'll still be constrained, but I think you'll probably see a reallocation of where people put resources to what level of compute. People are finding ways to do things like creative. You're starting to see all these companies, originally they all wanted to be kind of on the grid. Now they're actually going behind the meter, right? They're trying to find different ways to kind of get power. They're trying to be creative with, managing the power. There's a data center business that's actually leveraging, kind of old Tesla batteries as kind of backup for their power because, if you're behind the grid, you need to smooth the power. And you can't, because you can't burn the chips with like huge fluctuations in power. So there's all kinds of things that are being created.
Including coal, by the way, is coming back, right?
Yeah, modular nuke. I mean, they talk about everything. But again, power is still, I think the constraints are still there, which is, again, it will probably, I don't think it necessarily impedes performance because people are going to dedicate the leading edge of the model, like the resources of the leading edge of the model. It may have an issue for other things, which may mean there's opportunities for the inference chip providers and other people that are coming up to be able to take on some additional sort of resources, but it's still, we're going to be in a world where we're still constrained for the next series of years. It's just not, at least in the US for sure.
And that'll, I think, there'll be parts of the ecosystem that are going to be more challenged. So I think because AI is so powerful, so important, that's where people are going to resource. And so when you get into periods like we're in today, and probably will be for a while, where things are more constrained, there'll be other segments that end up being kind of pushed aside, if you will, so elbowed out. That'll be one of the issues, I think, for other big memory consumers historically of things like PCs and handsets and maybe consumer items. Those will be hard to probably go and get. So it probably means that prices go up. You could see issues in terms of just demand for, like, if a smartphone is going to become more expensive, as an example, does that slow demand? So that doesn't impact the AI situation, but that is just maybe some
Trickle
of the
down.
Yeah, exactly. So that'll be one of the issues. And the other thing just to kind of be watching out for, I think, is that because the growth here of this AI wave has been so significant, and we talked before, like, the industry is heading to $1 trillion. We thought that was going to happen in 2030. It's 2026. So the rate of change has been pretty significant. And one of the things that happens, unfortunately, with investors is second derivative of that. So it's not enough just to keep growing. For a lot of investors that are momentum oriented, it becomes the rate of change. And so when that second derivative starts to change, that's where it becomes more problematic. So as an example, just look at the last 3 years of just Capex for what's happened in AI infrastructure. It was about 60% in 2024, about 65% last year. This year's about 70% growth. These are huge numbers now. $800 billion to spend this year. Is it going to grow another like 75% in 2027? Maybe. But that's been driving, obviously, a lot of the economics of the semiconductor companies. And so for all of tech, what we have to really kind of focus on is when we start to reach that inflection point where the growth starts to slow. So it's still growing, but it starts to slow. That's where you might have some issues, and it'll be kind of hard for people to understand. Is that because there's a demand problem coming, or just because things got a little bit overinflated when the broad market trades at the P multiples does today? That'll be kind of a big thing to focus on. And I suspect that's the discussion we'll be having, towards the end of this year in 2027, because, I just don't know, like the semi industry this year is going to grow like 45%.
Yeah.
I doubt it's going to grow 45% again in 2027. I'd love it, but it seems like it won't.
Right. Okay, so last question. What are we underestimating about AI?
I mean, I think it's going to be just the pervasiveness and durability and the things that today we can't still contemplate, just like you couldn't have contemplated 5 years ago what it would look like.
Right.
And so, and that's, that could be scary because you don't know how it's going to go. It won't be just, people driving it. It'll be, the AI driving some things. So that'll be one of the things that I think will be important to think about.
I think it's, when you think about, like, we all kind of grew up with all these great things about technology. We kind of all grew up. We remember the moon launches and all these things like that, right? And we all thought we'd be, traveling in supersonic plane. I'm a big nut about that stuff, like technology. And so what I think that we're probably, when I think about AI, what I think it really will enable, and all the great things about how we live our daily life, things will probably get better. But I think it's actually, when I think about it, I think like a lot of it is like the infrastructure of the future. Right, it's going to enable so many different things, whether it's in robotics, automation, or autonomous, whether it's transport or whether it's delivery of goods. It's going to enable, as you think about space travel, like the need to have that intelligence, like go beyond just what we do here. I think there's tons of opportunities. So I think it's to me like it's the next, it's the infrastructure upon which we build the next kind of growth segment of the economy. If you think about things were built on railroads, they were built on steel, they were built on semiconductor. This is just, AI is now the next layer of that. And so I think, again, it's probably not something you see over the next couple of years, but my personal view is in the next 20 years, it's going to be, we're going to look back. It's going to be a little bit like, I remember we had a research analyst, Mary Meeker, who said Amazon's going to be this amazing stock. It's going to be worth $400 a share. Everyone's like, you're nuts. It's never going to get there. Turns out 400 was really, really low. And so I think it's hard to think that big, but I do think this could be something that really changes the fabric of what we know. And so I think it's pretty exciting to think about, because hopefully we're all still alive when you look back 25 years from now, and it's going to be, wow, we were underestimated how much it changed the way we live and changed what society is.
Well, you left out healthcare, so I think the odds are good if we live long enough and the innovations continue, we will actually definitionally live longer. I think.
I think it's going to be fascinating. Fascinating to watch.
Well, when I started out, I said that after I interviewed these CEOs of these AI chip companies, that you get so excited about the future opportunities, and so you didn't. You got me re-excited again. So I think that great days ahead. So appreciate you guys being here.
Thank you.
And sharing your thoughts with the listeners.
Appreciate it. Thank you very much.
It's going to be an interesting future.
It will be.